The same example that we have discussed in our previous video, a diagram has been depicted to the same demand and supply function. Let's try to interpret what are the consequences occur when implementing a unit tax. Now in this graph, this would be price, quantity, and this is the supply curve, S1, and demand curve. Now once the unit tax has been implemented, it would shift the supply curve to the left, S2, and the unit tax was 10 rupees. So as you can see, after the unit tax, the new supply curve is parallel to the old one. And as we have seen earlier, the equilibrium where the initial supply curve S1 and D was intersecting was at price 30 at unit 300. And now after the tax has been implemented by 10 rupees per unit, the equilibrium price have increased from 30 to 35 rupees. And the quantity demanded now, as we have solved in the equation, it is now 250. The producers now get only 25 rupees. At 250, as you can see, the producer's price only 25 rupees. As 10 rupees they need to give it to the government. Okay, now let us look at the consequences when implementing a unit tax. The first one would be there is an increase in consumers' paid price. Consumers' paid price would actually increase from 30 rupees to 35 rupees. And consequently, the producer's receiving price would decrease from 30 to 25. Producer's receiving price would decrease from 30 rupees to 25 rupees. And the third point would be there is a decrease in equilibrium quantity from 300 units to 250 units. So quantity equilibrium would also decrease from 300 units to 250 units. And the fourth consequence would be there is a change in consumers' expenditure. As you can see, the consumers were spending 30 rupees per unit for 300 units, which means 9,000 rupees they were spending. But now it is 35 rupees for 250 units. As we have solved, it is only 8,750. So there is a change in consumer expenditure. And also there is a change in producers' gross income. Before they were getting 30 rupees for 300 units. Now they are getting 35 rupees at 250 units. So there is a change in producers' gross income. Now there is also a decrease in consumer surplus. If you look at with the initial supply curve, the consumer surplus would be this whole area, and the producer surplus would be the below triangle here. But now the consumer surplus has been reduced only this upper part. Let's try to mark it down so it will be easier for us to understand. If this is A, B, C, D, I'm not using the letter E because of equilibrium. F, G, H, I, and J. Now, so consumer surplus has also been reduced. Before it was the area of A, B, C, and D. A, B, C, and D. Now it has been changed to only to the area of A. And there is a decrease in producer surplus also. As you can see, this is the whole area, and now it has been reduced to I and J only. So producer surplus has also reduced from FGHIJ, it has been reduced to only I and J. Number 8 would be There is a government revenue here. As you can see, BCFG is the government revenue. This would be part as government revenue. So government revenue now, before there was 0, and now you can see there is a government revenue. From 0 it has become for the amount of B, C, F and G. So it will be B, C, F and G. And now the important point is there is a dead weight loss. This part D and H is actually lost to the community. This has been lost. So there is a dead weight loss. Dead weight loss or decrease in the surplus, the welfare, social welfare, which would be D and H. And consumers has to bear the amount B and C, and producers have to bear the amount G and F because of tax burden. Now these are the consequences and the impact of taxes on market operation. But can we calculate this amount is the next question. So we would discuss and we will try to calculate what would be the exact amount that is being decreased as consumer surplus and as producer surplus, and what is the government revenue and what is the deadweight loss.